We're joined by Todd, who's over at FIIG Securities in Sydney, and all the while we talk about the fiscal side of things. Of course, hopes, Mark, that we still, well, hopes from equity markets anyway, that we still see more on the monetary side of things. This expectation of stimulus, is it all realistic? Is it going to come?
I think it's unlikely. I think the equity markets live in hope. They've been doing that for quite a while now, Brooke, as you and I have discussed over many interviews. The equity market is looking for any of that stimulus that can be based on government pumping money into the system. It's a free carry and buy into it. The problem for the equity markets and the problem for the idea around this stimulus at the moment is the Fed and the political environment. Lagarde speaks about the fact that we have a very combative two-party system in the United States at the moment, that there is no easy area for the middle ground, and as a consequence we are looking at the Republicans being very aggressive in the way they treat the deficit and the actions to the deficit, and they are kicking that can only a little bit down the road so they can get some voter buy-in around the idea that you should never have debt, you should never borrow money, and as a consequence it's a very bad government, regardless of wherever the debt was generated, whether it was in the Bush era or the Clinton era or the President Obama era. The Republicans feel it's a real vote winner by talking about debt as a consequence of action. So November becomes a real driver. If Obama wins and wins comfortably and he has good support in the Congress, then I think you'll see that fiscal divide, that fiscal problem be smoothed, and you can see that there will be an extension on the ceiling. But at the moment, it's all politics. It's all about where Bernanke has said and has consistently said that for him the driver is not the growth in the equity markets and that jobless recovery. It's more about the housing market, and it's about keeping the long bond at levels that will support appropriate mortgage levels. Under 5% is an appropriate mortgage level in the United States at the moment, and so that's to stimulate that mortgage market and all the outlying growth in those industries around that mortgage piece.
Although rates have been so low for so long, and yet still the housing market is in the doldrums.
I think it's hard. It is all around the confidence. It's the same as the RBA here. It's about how you jawbone it. The market, in the United States, it's understandably there's a lack of confidence because it is a jobless recovery. And if you look into Europe, you don't see any strength coming out of Europe, so there's a real lack of confidence around that piece. So you have very combative political environment that creates uncertainty. You have a recovery based on the workers creating greater productivity for the company because the company drives them much harder. There is a lack of confidence around what's my long-term future look like. Am I selling a product into Europe? Do I have a job where I can get a pay rise? Historically in the States, they just pay rise with the CPI. Whatever the CPI was, you'd always get a pay rise. That behaviour has now gone. It just doesn't happen anymore. And that was a real shock to their system.
And that lack of confidence, in the way that's been feeding back through to us here in Australia, we've seen quite a bit of attention in Australian government bonds. And in fact, we've seen some historic lows this year for those bonds. I guess there's a question about whether they continue to rally, and what does that depend on?
I mean, the Australian bubble bond, I mean, when everyone talks about the bond market, 80% of the population just think of the sovereign debt market, and so it's the Australian government bond market. And that is really the domain of the ultra professionals. That's the industry investors. And they are looking for 10 and 12 point movements, 20 point movements on any given day, and they're looking to trade that. That's a very liquid asset. And we know anecdotally that all the information is that it is a safe haven for the foreign investors. They are looking at our economy and our government and the capacity for us to pay back debt, and they're saying a 3% return is an acceptable return. In terms of self-managed super funds and all the traditional investors, government bonds are not where you want to be, because when there is a sell-off in that market, it will be aggressive and it'll be very quick. You need to be in the comfort zones where you're looking for low volatility assets, and at the moment, though government bonds have gone all one way, they still have the capacity to be quite volatile. So
where out there can you see that offer of less volatility or less potential for big, sizable negative moves?
Yeah, I think it's still the hardest thing for the investor community to get their heads around is duration. they want liquidity and they buy something, they want to be able to liquidate it and get their money back, or short-term investments, 3 months, 6 months. But for those investors that are looking at the macro and thinking about your investment horizon being 10 years and 20 years, ultimately you will be, assuming you live long enough, the longevity piece, but you invest for these long durations. You can buy infrastructure assets, and it's been in the paper today, you can buy infrastructure assets that are linked to inflation that will give you a 5% return plus an inflation. You are, I guess, inflation will be, the RBA says it's 2 to 3. Let's make it 1.5 to 2.5. You'll get a 7% return, and I think historically anyone that can produce a 7% return over the next 10 to 20 years is in the Buffett pool, as opposed to people who are trying to work out whether BHP is good value at $50 versus 33 or 31 now. It's an easier trade to put some of your money to work at 7% per annum than trying to pick the equity markets at the moment.
Mark, let's just quickly finish off by mentioning the RBA outlook. All this comes into play, of course, all relevant. We saw that statement yesterday, and you helped us with the live coverage. You're particularly pointing to the inflation outlook from the Reserve Bank of Australia, the fact that it looks fairly reluctant to cut rates even further from here. With 24 hours or almost 24 hours to digest all of that, where's your thinking in terms of the outlook for rates and from the RBA?
I still think the CPI is the key to it. It is benign at the moment, and the point the RBA is making goes back to that longevity that I speak about. It doesn't expect it to stay benign. It expects it to come back, and as it moderates back towards trend, the RBA will be very careful on monetary policy because it doesn't want it to overshoot that 3%. The way to make sure it doesn't overshoot, or assist in making sure it doesn't overshoot, is to not drop rates too aggressively. So I think the RBA will want to wait for as long as it can before it makes the next move, because it's saying it's below trend now. It will not stay below trend. It will move forward, whether it be via the carbon tax, or whether it be via wages push, or whether it be via commodities. But it believes it'll go back, and if it goes back, it really doesn't want it to overshoot, because then it has a whole different ball game and it starts to raise rates, and that will really hurt the economy.
Mark Todd from FIIG Securities, thank you so much.
Pleasure.
Look forward to chatting next time. Thanks.
Bye.